Hello. Very good. How are you? How was your trip? Excellent. Oh. Well, yeah. You never know what's going to happen. Anyway, nice to see you. Thank you very much for coming on. looks as though perhaps that was appropriate. But oh, tanks. Well, here we are. At least I hope we are. Yes, hello. Welcome. Nice to see everybody on, and thanks for spending some time with me. We'll just in pre-show mode for a moment or two. I should explain that I've had a couple of issues with the switcher this evening, with it phantomly doing things. So it must be haunted, whether that's past shows coming back to haunt me or something else, but slightly weird. Anyway, I think it's okay now. And I've got Damien teed up ready to come in. Of course, I've got the dogs here as normal. They've now both decided to go back in their basket. You saw perhaps earlier on that Mita decided to go for walkies. So we only had one dog. But anyway, there are the two doggies there. Hopefully they'll be quiet, although the bins get collected, so you never know. And for those interested, that's the setup. Damien's teed up ready to come in over there. I've got the various control systems up and running. I'm monitoring the audio particularly tonight because of some of the issues I had before the show. So hopefully everything will work. It's a bit like juggling plates. You hope that everything will be fine, but sometimes for no apparent reason, things go wrong. Anyway, we're up to 8 o'clock, so I'm going to take the pre-show off. I'm going to run the start of show. I'll be back in just a moment. Well, good evening and welcome to the live stream. It's Tuesday. Once again, it's the 10th of June, 2025. It's Martin North here from Digital Finance Analytics. Great to have you on this evening. Thank you for taking some of your time out. And we're going to have a really interesting conversation with Damien this evening because, well, if you read the latest news, superannuation funds are now back up to where they were. The markets are back up to where the ASX, of course, is doing particularly well at the moment. Here's the latest on the ASX. You can see there we're touching this ASX 200. We're touching all-time highs again. So everything must be doing well. But the question is that really the full story? So that's what we're going to explore a little bit tonight. I should just remind you, as I always do, they're not providing specific financial, legal, or whatever else advice. This is a general conversation only. We moderate the chat, but feel free to throw your questions, comments in. I'll try and track it as we go through. If you'd like to ask a question of Damien or myself, if you use it Walk the World, that'll get it into my queue. Make sure I see it. I've also enabled Super Chat, which means that if you would like to make a contribution to what we do around here, you can do that via Super Chat, or indeed get your question to the top of the list. All quite useful in terms of being able to help with keeping the show on the road. We don't just profit, we do this because we think there's a really important conversation to be had, and frankly, in the current environment, never more critical than ever. So let me bring Damien straight in. Damien, welcome back. And you've been away, so nice to see you back.
Yes, yeah, good to see you, Martin. It's been a little bit longer than last time, but yes, there's obviously lots going on still.
Yeah, and there is lots going on. And it's very interesting, the talking heads have changed their tune in the last month. A month, 6 weeks ago, they were talking doom and gloom, a crash in the US, significant falls, the market's overvalued, et cetera, et cetera. And now here we are with, now everything's fine. China and the US are talking about trade, so that's all good. The trade stuff, well, it's an issue, but is it really as big an issue as ever? The bond rates, of course, are very high. The long-term bond rates in particular, they were touching 5% in the UK particularly, but also in the US and even in Australia. So I guess the question is, are we back to normal or are we in some strange new parallel world, and how to try and think about it? And then the other question, because how does this intersect then with your portfolio management strategy, your investment strategy? Because, we said, I think a few weeks ago when stocks were falling, don't panic, things may not be going just one way. And well, here we are again. Yeah,
that's right. So look, I'm going to frame this. There's two different parts I want, and this is just as a quick, I guess, warning to people. There's probably going to take a fair bit of time just talking about these two things because there's so many little parts to it. So one is the sort of the overall overarching. How should we think in a big picture about about Trump 2.0 and what that means for investors based on what we think is actually going on. And then secondly, that point about is everything normal? We're back to normal is there's a list of a dozen things that could sort of knock this off kilter, and any one of them could knock it off if done badly enough. or a combination of a whole bunch of them at certain levels. But then there's this idea that there's the word the taco trades obviously come out a lot, which is that Trump always chickens out, and so that idea that what does that mean in terms of will he be pushing limits everywhere? But if any of them gets close enough to knocking things off, then he'll backtrack and so as long as you had a strong enough US economy ticking along in the background, and he's making lots of noise and smoke and mirrors and all that type of stuff going on over here, is that actually it's all just a distraction, and there's actually not a lot of change going on. So I think Doge is probably a great example of that in terms of we're going to fire everyone, we're going to lay off this, there's going to be trillions of dollars worth of savings, and where we are 6 months later, and there's airlines out, and depending upon who you want to measure, but there might be 50 or so billion dollars, and so net effect is very little for the amount of noise and smoke and mirrors that are going on, is everything going to be like that? And so that's the sort of part about which we can run through in, I guess more detail after.
Yeah, I think that's perfectly right. I guess two other questions which I think it's worth thinking about. To what extent is the Australian market simply piggybacking on what's happening over there, right? Or are there local things going on here? And of course, one of them, of course, is the CBA, which is stupidly high, and it's got quite a lot of coverage. This is the CBA chart, 182, which puts them much higher than BHP, in the same class as Nvidia, et cetera, other than the revenue probably isn't quite as strong. So you got the question here, are we just following everybody else? Or is there something else going on in Australia that actually is changing some of the dynamics? Our markets, well, they seem overpriced to me, but maybe I'm missing something. And then the other question, is the debt. Now, I spoke with Harry Dent the other day. I've got a show coming up where Harry's going to talk to me in more detail about the amount of debt in the system. And he's always argued that there's too much debt in the system, particularly government debt. And of course, with the US bill, the beautiful bill, going to potentially put more debt in the system as well. Not only there, but you've got Germany with their defence investments. You've got the UK talking about having to fund more investment there, and have changed their fiscal rules. We've still got this overhang of significant debt in the system, such that we've now finding that some governments are paying more in the debt repayments than they are on things like defence or even social security. So, underneath the surface, you've got this debt pile sitting there too. And I wonder whether that's something else that's behind the scenes, potentially also defining at least a new normal, if not normal at all.
Yeah. And look, while debt's up a little bit, I think the thing to note is it hasn't really changed. Like, I think the long-term rates in the US were sort of, 2%-ish. A few years ago, and then they sort of rose to sort of 4 to 4.5%, depending upon 4 to 4.5 on the 10-year, and closer to 4, sorry, on the 10-year, and then you've had a recent bit of a rise, but overall, like compared to the rise we had over from the 22 to 20 to 25, it really hasn't been much of a change at all in terms of the levels of debt. Yeah. And then similarly on the 30-year, so if you sort of said, okay, well, where are we now versus where we were last year? You're like, yeah, it's up a bit, but it's not dramatic in the same way that that we were, over that other period. So will it make a difference? Absolutely. Every little bit makes a difference. It's not at the levels where I'd be saying it's a break on growth. It's not a massive effect. I think there's, I think Trump would love the economy to be ticking along, and he'd love the stock market to be ticking along, and so he's more likely to be spending money on debt than not. I think in the past he's expressed his maybe not his desire to go broke, but certainly his desire, things about not paying people if he doesn't feel like it, and he's certainly done that within his own companies. I think he has a different view about what debt means to, I think, a lot of economists in the US, and these risk-free rates, and issues with the Fed and all that type of stuff like that. I think there's a whole bunch of things going on in the background that could blow up. But I think at current levels, I don't think they're at levels which I'd be sort of, every little tick up, is a little bit worse. But where's that tipping point? And actually, that's probably one of those ones. When we get into that tipping point, we can talk through a little bit on that. In terms of the Australia, I'll just pop up a chart. This was a Jared Minack one that came out the other day, which sort of illustrates pretty much what I've been saying with a lot of, and certainly what we look at in terms of our investments. Is what we've got here is the forward PE for the Australian market, and this includes resources and banks, which actually is better for Australia than not. And then on the bottom is the forward growth, and so ideally you'd expect that low growth markets will be bottom left. And then the higher the growth, the more you pay for that, and that sort of works for a lot of the rest of the world. But you can see Australia sitting pretty clearly as a different over on the side there. Now, the thing that actually this doesn't reflect is that Australia's is chock-a-block full of banks and resources, and banks tend to trade on a lower, like if you look at on a lower multiple than everywhere else, because it's a very different business model, much higher levels of gearing and everything like that. So there's more that can go wrong. So if you look at every other country, the banks trade at a big discount to the rest of the market. And then resources is a similar story in terms of the earnings versus the PEs can get disassociated from the fundamentals. What I mean by that is that if the oil price runs up to $120, then what you might find is that oil stocks might be on a really low PE. They might be on a PE of 5 or 6 times earnings, and that's because nobody thinks that $120 is going to last for a long time. Whereas when the oil price sort of hits $30, everyone's like, "Oh, these prices are too low now. They're not going to last." The oil companies might be on 100 times earnings and not making any money. But it's almost an inverse. You buy them when they look like they're cheap, and you sell them when they look like they're expensive. And so, because that distorts resources, if you sort of took resources and banks out of this equation, Australia would look even worse on that scale in terms of how expensive we are. We're pretty close to the same as the US, but on much lower growth rates.
Just a quick question on that, because some of the articles around CBA were arguing that one of the reasons why we've got probably some uncertainty in the market here is because CBA is a large part of the overall market. All of the the index funds have to pile more into CBA as it goes up. And in fact, because of the way that those work, maybe it's distorting the overall market, and not in a good way. I'm not sure whether that's the full story, but it does seem to be quite interesting. One, we have this superannuation flows coming in all the time, and they need to put the money somewhere, not only in Australia, but consistently in Australia, of course, as well. With this small number of very large types of players, financials and miners and a couple of other, hangers-on in that top tier in Australia, it gives it a really weird shape relative to the US. And yet, if you look at the US and you look at the S&P 500 and you take out the Mag 7, it's gone almost nowhere. So as soon as you start looking at markets,
concentration.
Concentration risk is what I was heading to. And it seems to me that concentration risk is something that we've got not just in Australia, but we've got it in other markets too. And therefore, all of those EFTs and all of those index funds are in a way stoking this distortion because of the fact that a few big stocks drive the market.
Right. Yeah. Well, okay. So there's a couple of elements to this. I think there's a truth insofar as large cap versus small cap. So what do I mean by that is that the top 60 odd stocks. So most international investors invest in what's called the MSCI Australia, is sort of their benchmark. That's about 60 or 70 stocks sort of fit into that. And so if you're an international investor and you're just buying, you just want exposure to Australia. You're just like, oh yeah, Australia's got lots of mineral resources going well. hasn't been through a recession for so long, whatever, world growth is going to be all right. Want some exposure to China. How do I get it? Oh, let me go buy Australia. If you go buy the Australian MSCI Australia fund, and that'll get the top 60 or 70. And that definitely distorts between companies in that and not in that. There's a bit of a, you get that sort of jump up in terms of those. Within the Australian, Australian investors have, the ASX 200 is a pretty common index, but there's a 20 and a 50 and 100 as well that sort of people will invest in. And so there's not as much distortion as you go up that chain, but I think at the 200 level you do see a bit of distortion. So if companies within the 200, they've got that little bit of a price jump over the companies not in there, just because you move into that and all of a sudden, whatever it is, 10% of your stock or 20% of your stock is going to be held by these index funds. Or quasi-index funds. People are benchmarking themselves to that as well, and whereas the international stuff, it's probably more that top sort of 60 to 70 stocks that where you really get that difference. So that's sort of a long way of saying, yeah, look, that does affect CBA, but CBA is not that special in terms of those. So all the other banks would fall into the same category. So CBA does, we often joke about it being the Magnificent Eight. If you take the Magnificent Seven that are actually growing and you add CBA, because it's on the same price as all these other ones, but its growth rates are like way worse. And so why would that be? Well, a couple of different reasons. One is, as we saw from the last election, the Australian politicians are pretty set on providing lip service to lower house prices while having policies that will just stoke the house prices higher. So from a banking point of view, most of the Aussie banks have not ceased, but they used to be, and particularly NAB and ANZ used to be what you call business banks, where they lend a lot to businesses and you lend a little bit to your housing market. Whereas now they're all largely, the Aussie housing markets. That's your real big risk. You have a downturn in the Australian housing market. That's what's really going to smash banks. And based on government policies and interest rates probably falling for reasons outside of Australia's control, there's that's sort of leads you back to saying, well, it's not as dangerous as it might be in a more normal scenario, more normal economic scenario. And then you have this whole thing about, well, the Australian banks, we went through this what felt at the time an excruciating Royal Commission where they were lambasted for all these things they were doing wrong, and in response, we basically did nothing to help sort of any of those. We had all these Royal Commission things, which basically just wet lettuce was as it's apt to be said about how much regulation they actually had. And so if you ever took the view that, look, the Australian banks, they haven't got the downside risks are largely not there based on where we are in the cycle and housing prices, and they seem to be really close to regulators, and the regulators are basically letting them earn these massive amounts of money. They're effectively guaranteed by the Aussie government, and you've got you're really close to so you basically be allowed to earn higher returns than what you're getting elsewhere. Then there's sort of that sort of all comes through as to reasons why the Aussie banks might be all right. I still can't get to the CBA share price. Like if you sort of you can get to maybe the other three banks which have got they're still elevated in terms of valuations, but there's nothing like what you're seeing for CBA. I don't know is the answer. I can't come up with a good reason for why CBA would be priced similarly to all these growth stocks in the US.
No, well, I mean, it was interesting because some people were speculating, well, is CBA essentially, really an AI stock, and I did a show which was, is CBA greater or equal to NVIDIA? And basically said, I don't see it. I just don't see how it can possibly be. But, there are people in the market who fundamentally think that there is something. But if you look at the way they make the money, if you look at the margins that they're making, I can't make sense of it. And yet the market is saying it.
And you take banking profits, as a proportion of GDP or whatever it is, how you measure Australia, it looks pretty high on all those measures. And so you've got to make the argument that it's going to go even higher, and maybe it will. Maybe that's where we'll be. That's where maybe where all our money's going to be going is pouring it into banking fees and higher interest margins and what you see elsewhere. Banks, but I just.
Well, they're so far, and people like Richard Wiles and a few others, who are looking at this stuff. They got sort of fair value prices, and in fact, Cookie Boys put this question up. A 120 to 160 range. So it's so far from where it is that you've got to say, well, how can that be?
Yeah. Well, I mean, typically. Just big picture numbers, I would think about banks as trading on a discount to the market of, 20%, 15-20% type thing over a typical cycle. So if you sort of said, the market should be on whatever 18 times or something like that as one of the longer term averages, and then you took off a bit off that, maybe getting back to sort of 14, 15 times for the banks as trading on. And CBA is sort of on, not quite double that, but certainly 50% higher. So, yeah.
And Cookie said, what about the others? Well, the others are, if you look at the share price trends, it's a very different story. And okay, there's some new management in a couple of the banks, but yeah, I struggle. So having done the local market and the CBA, let's swing across now and just try and decode Trump, right? Because like it or not, at the end of the day, what happens over there in the US is fundamentally important to pretty much every economy around the world, not least directly, the trade between Australia and the US, but also indirectly because of China and what happens with regard to China. So I guess the fundamental question is Trump playing three-dimensional, 12 moves ahead chess?
Yep.
Or is he completely tactical, reactive, frankly, looking to make money, maybe for himself and his cronies, without any strategic context at all? And, you can have a continuum, right the way along there, one into the other, right? I don't know. Absolutely. I don't know where to put the marker at the moment. I keep moving it around.
Yeah. Yep. So I think, there's certainly that thing, he's playing 3D chess, everyone else is playing checkers, and in 10 years' time, we're going to look back and marvel at how brilliant he was in terms of his process or whatever. Look, maybe we will. I can't see it, but he's got me. If that's the case, he's done a great job of putting in incompetent people into various parts and stuffing things up and, mixed messages and all that type of stuff like that. So if he is doing some sort of 3 or 4 dimensional chess, that's he's beat me on that. So I'm sort of going to exclude that as one of the options. Maybe I'm wrong. I think there's sort of 3 big points that 3 big parts that sort of, and I think that I think they sort of all fade together into a 4th one that I'll talk about. So one is, look, he's got a short attention span. He's a narcissist. He loves to see himself in the news. And he doesn't like doing a lot of work. He's just winging it. I mean, that's one view out there. And you're saying, okay, well, if that's the core truth behind this, then what do you do as an investor? And you're like, well, it's pretty hard to invest in that type of market. You've got to sort of take some longer term averages and just sort of pick a spot and rely on the fact that, look, will he blow things up so badly that it'll ruin the economy, or is there going to be lots of smoke and noise, but there's no real damage done? So there's one point there. The second one is that, well, that's true, but actually what you need to watch is his advisors behind it. And you see these news reports coming out about, Navarro's in there and piling on tariffs everywhere, and and Besant and others are waiting till Navarro's left the room before they run in and convince him that no, it's gone too far. You got to flip it back off again, and so it's just like, well, if that's the case, and he's being manipulated by these advisors, are we investing on the basis of who did he speak to last? Is that what the case is? And you can see that there's the Trump-Musk fallout is important in this context as well. Is that Elon's Trump's best buddy, and decimating the running through his chainsaw through all the costs and everything like that. And the next thing he's out and Elon's calling Trump a pedophile and Trump's talking about taking away contracts from him and all this stuff that's going on there. That have I got if I bought into Elon's the guy who's driving this whole show, and then all of a sudden he's on the outer, and so I need to completely change my investment process, or is it current Treasury Secretary Scott Bessent, but if something happens and Trump suddenly decides that isn't what he likes anymore, or Navarro's there and he suddenly decides that Navarro's got it wrong, and he went through so many different advisors last time, is that you could set up some sort of investment strategy based on who you thought was pulling the levers, but you're sort of down to, well, who was the last person to speak to him, and will they still be there, and all that type of stuff. So that's your sort of second one. Third one is Scott Galloway has been sort of talking about this one in recent weeks, and it's quite an interesting thought that I hadn't really crossed my mind. But it's probably not a bad lens to think about in this. Is that he's basically saying, well, Trump's just interested in the grift. Like, the whole idea is he wants to make as much money as possible from being president, and whether that means accepting $500 million jets from the Qatar or using it to build Trump golf courses and Trump towers and all these other things in all these different countries, is that all he really cares about is that making the money. And there's certainly been a number of different things out in terms of trading that's been going on with people inside the tent, so to speak, and not knowing as much about what Trump's doing with himself. And so maybe, is it that some of this is, let me announce these tariffs and I'll make sure everyone I know that is of importance is on the short side of the trade, and then once they're out there and the markets fall, then I'll let I'll then give everyone the warning before I go and flip them around, so they all get a chance to buy back in. And so is this just one big grift game that's being played, and it's about manipulating markets and doing whatever it takes to make money? And so so that's sort of a third one, which I must admit, there's some interesting data points there that say, at face value, you go, no, that can't just be all. But maybe it is. Maybe there's the idea that, I think what he's talking about is saying, well, he doesn't wake up saying, I'm going to go in and be horrific to whatever group of people that he's going to, do it to the next one. But if it's going to make him money, then, they're just collateral damage. That's, they'll work it out. They're all adults. They can sort it out themselves. So, and the last version is basically saying, well, what if all those last three ones I was talking about are true? So not the 40 chess, but all these other ones, he's winging it largely with a short attention span and a narcissist. He just likes the attention on himself. He's being manipulated by advisors, but they're all different advisors and they've all got their own things. And it is a little bit about who the last person to speak to him was. And he is deeply involved in the grift and cryptocurrencies and all these other things that's going on as well. And so if you've got all three of those things going on, but there's sort of this natural selection over the course of it, which is he does have a short attention span and he doesn't like taking pain. He doesn't like markets falling. And so this idea that Trump always chickens out, or taco as the markets are calling it, is that, he's got a short attention span, he'll do stuff. But you know what? If it's painful, he'll drop it. And he is being manipulated by his advisors, and they've got certain things they want. And he'll sort of go, he'll go, oh yeah, that Navarro guy has convinced me, I can make a whole bunch of things, and I'll put on 100% tariffs and 300% tariffs and do all these things like that. But actually, once it starts to hurt in markets and I get squealing, I get a bunch of phone calls from CEOs and prime ministers and all these people like that. It's great for my attention. It's great for my sort of narcissism. I'm the center of the world. I get to I get to take all those calls, but it's obvious when they're in too much pain, and so I'll reverse it, and so it's sort of, you end up in this sort of some sort of natural selection type thing where he's just trying a bunch of shit that sort of made sense at the time, or somebody convinced him to do. And if it gets painful, he drops it. And if it doesn't get painful, he keeps it. And so, if that's the world we're living in, which for me sort of feels like about right, is that there's a bit of an argument for saying, well, as long as he doesn't stuff things up so badly inadvertently, then you just buy and you just go, well, natural selection will work things out. He's probably he'll keep market friendly stuff. Some of this stuff might be bad for the long term, but in the short term, it's that whole, when you get a new credit card and you're running up the credit card, it feels really good. I haven't seen my first payment. I'm out having lunches and dinners and buying new stuff for everyone, and it's not until the credit card bill hits that you see the pain. Well, he's probably not going to be around for the credit card bill, so run it up, enjoy, live it up, and enjoy life. And so that's sort of this big picture thought that we have, and then the question, I've got a dozen things, and you might have some more as well. Like, what are all the things that could knock this off course? And so what are the things we're watching to try and work out? Okay, has he inadvertently or just unknowingly gone too far in something and blown it up?
Just before we get into that, quick question. We know that Trump has been a tariff man for a long, long time, right? You can actually see statements that he made way before he went into politics, and even in the early days of politics. And he's always believed that tariffs are effectively a very powerful set of levers.
Yep.
And I am very interested on whether the levers are more to do with applying leverage and influence, or whether it's more about trying to genuinely generate additional revenue. Because if you look at the amount of revenue that people were saying could be generated through tariffs, particularly when they were very, very high, and what's actually being captured, there's quite a gap. It's up a bit, quite a bit, but it's not anywhere as big. But he is actually forcing people to come and pay homage, as it were, right? Force them into negotiation. So in a way, to my mind, the tariff story, despite that it may have originally had an economic basis, is more, to me, about ego, and it's more about getting everybody to come towering to him and to his administration and saying, I can wreck you if you don't dance the right tune.
Yeah. Well, okay, I'm going to separate that into two parts, the economics and the ego. Let me start with the ego, because that's the one that is concerning. And that's one of these things that could tip it off, is that, he had, what did he call the day? Was it Tariff Day? I can't remember. Whatever, where he was like, I'm going to unveil it on whatever day. I've got these tariffs and they're coming.
2nd of April.
Yeah, what are they called? He had a name for it. Can't remember what he called it. Might have been Tariff Day. Anyway, the amount of world attention, like the entire world was like, just a minute, is he about to blow up the world economy?
Yeah.
Like, everyone was paying attention. Everyone was focused on, and he gets to show his charts, and he's like, look up here, I've got China and I've got all the other ones. He gets like, if you bought into the fact that he's a narcissist and he just wants people to pay attention to him, then that was the greatest day ever. And the ensuing, people sort of queuing up to kiss the ring, is fantastic. Like, that's exactly what a narcissist wants. Everyone paying attention to him, and then afterwards, one by one coming and kissing the ring. So the question is, and the concerning part of that is, what's going to top that? What are you going to do next? Like, if you've had that rush and that thrill, do you need? Oh, there we go, Liberation Day. That was the day. Yes, thanks for that. If you've had that rush and that thrill, what are you going to do next to top it? You're going to have to create an even bigger crisis that everyone's well. So anyway, hopefully that's not on the cards, but there is that risk that if that's what of those things I think are put up in terms of what's driving. If narcissism is one of it, then maybe we need to threaten a war with somebody, or we need to whatever it is. Like, there's a I don't know. Anyway, there's a concern there. But let's get back to the economics quickly, because I think there's I'm certainly of the view that I'm not going to say anything different in terms of it. It's a tax on the US consumer and all these things like that. Similar to what everyone else is saying. Now, is there fundamentally, if you're looking at a problem though, where you've got some countries which have kept their currencies too low, they're producing way more than what they're actually consuming, and they're pushing all that production onto other countries, and so you've got a bunch of other countries in the other way around, and the US being the biggest one of those. So the US is consuming too much and not making enough. Is a tariff a good solution to that? And you're like, well, yeah, it's not too bad. Like there's a, okay, let's not pretend it's not a tax on consumption. It is a tax on consumption. But if you're trying to get your production up and your consumption down in the US, then putting a tariff on it, makes a lot of economic sense from that perspective. Now, there's a whole bunch of other things behind it in terms of world trade, and I don't want to sort of say that I'm a belief that tariffs are a solution to everything, but they're a tool. They're one of the many tools you should have in your case. But I think he's decided that's his only tool, and that's the one he's going to drive. And part of the reason I do think that this is the reason why he's driving it is because he does have a short attention span. He doesn't like to have to go through Congress and go through, get policies and put them through House and Senate and debates and all that type of stuff about it. He loves to write it himself and just say, yep, it's an executive order. This is what I'm doing. And I think that's part of the reason why he likes the tariffs in terms of getting to the bottom of these is because, all those things about creating attention, but also he can do it. He knows he can just go and change it, and he can change it, subject to courts, which
I was going to say there are a few court actions currently in train, right, which may question.
But it is that part about he sort of did. I guess what it is last time he did it that way, and then it made it through, and so his thoughts are, well, I can just do it again. And so I do think there's a certain element to that. So I don't think the economics are great in terms of how they work, but in terms of solving a step towards the right direction, if they'd been put in like a measured way where it was like, here's what's going to happen, we're going to put tariffs up to 40% on China and 10% on the rest of the world, and we're going to increase it at 2% per quarter, 2.5% per quarter. And here's the reason why the tariffs are on. And if you're doing this, we'll take them off. And if you're not doing that, we'll leave them on, or whatever it is. And we're going to do this over a couple of years, or pick whatever time frame. But there's a thought process behind it, and a policy and a drive into it. Then I'm on board, And I think that's where you can look at some of the things Besant's saying and the logic he puts behind it and go, yes, if that was your overall thesis of where you're trying to get to, then that makes sense. But it's on, it's off, it's 40%, it's 100%. No, it's back on again. We're 90 days. You got to come back again, and there's all this on and off again. That's where the danger is that the execution is causing so much confusion that you end up creating problems for the economy. But I will go and let me talk a little bit about, let's say, the inventory cycle. That's one of my first tipping points. This idea that we've got this inventory cycle, and I don't know what the hell's going on with inventories. And we're not going to be able to tell for, I don't know, maybe a year. It's going to be so. The big picture was we knew all these tariffs are coming. Everyone was out ordering all the stuff in the first quarter. And so you had this really strong industrial production in China as everyone tried to get their orders in before the tariffs all started. Then all of a sudden it went really weak for a month when there was, 130% tariffs on China and tariffs all over the place on all these different countries. Everyone just stops ordering and all the ships stop. Now everything's been paused for 90 days and, China's on or off. And so you've actually got quite a strong inventory cycle coming back on again, because if you're a supplier who ordered a bunch of things from China, now I stopped ordering it, left it for a month. Now I've got a period of time in which we've got sort of 30-40% tariffs or whatever, but it could be going back over 100. Maybe it's not. I'm probably actually getting back in and putting in a bunch of orders because and madly trying to change to different countries as well. But the inventory cycle and the ordering and all that type of stuff is just going to be a mess of companies on short inventory cycles, long inventory cycles, and just stuff going everywhere in terms of that. So I don't know what's happening. I don't think anyone's going to know what's happening until we can just see the washout and where is real demand, which we're not going to know for Yeah, 6 months at least, not until 2026. And even then, it could be this time in 2026 before we know.
And just a quick point on that. It's very interesting that a lot of central bankers have been talking about uncertainty, right? We actually don't know. We can't navigate. And there have been a number of federal members who actually said the data that we've got probably isn't very accurate. It's not giving us a good read. And even some of the accuracy data from the inflation itself in the US is also under question now from the Bureau of Labor Statistics. So have you got a compass that actually is flawed and faulty? Have we got a data set that actually isn't telling us the full story? And what are the lags implicit? And, I used an analogy the other week with Tarek Brooker, actually, about the movie On the Beach. That's the beach where the movie where there's an explosion in the Northern Hemisphere, right? And the nuclear spill slowly eases around the world, but it's months and months and months before it hits Australia. And I feel a bit like that now, that, the tariff bomb has gone off. I'm not quite sure the shape and size, but we actually don't know. We can't read what the implications are going to be. And that makes it very difficult to set policies from a central bank's perspective. Is it inflationary, deflationary? The Bank of New Zealand did quite a good scenario analysis saying, well, it could be either. We're not sure. And the consequences are quite serious in terms of do you pull the interest rate lever or not. So we are in this sort of unknown situation, and we won't know, not for a few weeks, we won't know for months and months and months, because the inventory transportation processes, it takes weeks to move stuff from China to the US or start. And what will the charges and tariffs be when those goods actually hit? Nobody knows. And that creates a level of uncertainty amongst firms. Do I buy? Do I not buy? Do I hold inventory? Do I not hold inventory? It also makes it quite confusing. Think about, well, what do I order for Christmas? If I'm a retailer, because I need to be thinking now about Christmas, right? And I know that Trump said, you should only have a couple of dolls rather than $50, and you should only have a few pencils rather than many pencils. Yeah. But seriously, this is a big deal. And if you're actually in the building and construction sector, or if you're in the investment sector and trying to build something big, like a nuclear power station, how on earth do you try and work out what the costs?
Well, the costs are going to
be. It shows you, when you stand back and think about it, just how much uncertainty there is, and therefore I'm of the view that nobody can tell you. So anybody who thinks they know how this is going to play out, they're lying. They can make an assumption, they can guess. Yep. But just like the central banks are saying, it could be this, it could be this, it could be this. We'll probably sort of put a stake in the ground in this direction, but we're going to probably have to change it later. And that level of uncertainty for me is probably one of the biggest questions I've got.
And if you use something like as seemingly simple as, say, an Apple iPhone, and said, what's the tariffs on that, and okay, they made a big contribution. Do they get their special services, whatever it is, and then there's whatever it is that they get on those. So there's a level of confusion around the companies themselves about, are they getting a special deal? But then you go, well, there's thousands of parts in this thing, and the parts jumping back and forth across borders. Even Apple's got very difficult for them to work out what's going on, and it's not until the tariffs actually hit, which ones which is it between this country and that country and back and forth, and did something actually end up in the US that we need to find an alternative path so it doesn't go back to the US, and that's the suppliers, the suppliers of the suppliers to Apple who that's affecting, and they don't even know about it because it's it's 2 levels deep. So definitely lots of stuff going on there. And that comes back to I guess the second point I had. So the first one's inventory cycle. The second one is this CapEx idea. Exactly what you're saying. If you're putting together something big, you don't know what the costs are anymore, and you don't even know. And you're like, looking at the example I think I used on here last time is, you're like, well, I built a factory in the US, and now I'm like, now I'm 20% more expensive than Mexico. Well, okay, so if Mexico's got a 25% tariff on it, great. I'm off and running. I'll have my factory in Mexico, but do I know it's going to be 25% or not? And so you just won't even do it. Like if it's on the drawing board, you're not sure about. So there's this idea that CapEx and the surveys do tend to show that the CapEx is slowing, and that's going to be that will be an issue. Having said that, now we've got this inventory back and forth and people buying, I've got a chance to buy something that some sort of component that I could have got from China that might be plus 100% in 6 months' time. So maybe I should be buying it, rushing it and bringing it forward now. And so there is probably a CapEx hold up, but we don't know what it is and how big it is and what the delays are in terms of that. And that's something, again, that could knock us off. Number 3 is this idea of large companies versus small companies. It comes a little bit back to what you're saying about the mechanics of tariffs. And this idea that actually large companies, this is a pretty big, given that the listed companies in the US tend to be big and global, and they actually have often have a much easier way around some of these issues than the small companies. So let's say I've bought $1 million worth of widgets from the Chinese supplier that I've been using for years, and that turns up, and the Chinese supplier, the Chinese factory, buy it off them. They give me 90 days to pay it. It takes them a month to get it across to the US. Then I go and sell it as fast as I can. And by the end of the 90 days, I've sold most of them, and I can put the money back into and give it back to them, pay the Chinese company. I'm off and running. These tariffs don't work like that. Tariffs have to be paid as it hits the shore. I don't get the goods until I've paid the tariff. And so I've ordered $1 million worth of goods from China. I've got to now come up with 300 grand to pay the US government before I've sold it, in order that I then make that money back by selling it. And so if you're a multinational company, fine, there's trade finance, something will happen, and I can work it out, and I'll add that to the margin as well, and make back the money on that. If I'm a small company, like I just might not be able to get that money. Like it might not be, or at least have a lot more problems around it. So there's that part, and then the other problem with small companies, large companies is, I'm a small company. I put in a big-ish order to my Chinese factory for $1 million of whatever, but it's big for me, but it's not big for that factory. And when this stuff hits and I need to, turns into 100%, and I need to find another country to do it in, when I'm turning up to a factory in Vietnam and they're like, well, no, we're already backlogged. We've got enough stuff happening. When, it's not a quick change as a small company. There's a you can go out of business, or it's a company transforming event. For larger companies, often they're already in a bunch of countries. Maybe 50% of your production does get done in China, but the other 50% is a mixture of some in the US and some in Thailand or whatever, Vietnam. Pick a bunch of different countries where you've got smaller factories, and so a big tariff comes on the US. Okay, I was sending all my stuff that was made in Eastern Europe into my Europeans and all my Asian stuff, into other areas of the world. But actually now, and my Chinese stuff ended up in the US. Maybe now I just need to rework my supply chains. Everything in China now goes to Europe. My Eastern European stuff goes to the US, and it's a matter of changing things around. And so maybe the tariff effect isn't as big on larger companies. And so what I'm getting to there is, if the whole part of this comes out, and when you're talking listed stocks, is that part of there's a switch from small companies to big companies, and so the big companies that are there actually end up benefiting, or at least easing the pain of the tariffs, and they've got a lot more flexibility to get around it, and so they end up with price rises and maybe margin increases because of this. So it might be actually some benefits for those large companies. And then the other part is a lot of those large companies are global anyway, and so their operations in the US might be affected a little bit, but maybe if the rest of the world gets slightly cheaper goods from China, then maybe net they're not that much worse off, or the earnings, it's not as much of a big earnings hit. So there's sort of two more sort of factors that affect that from that. That could this knock it off, course or not.
And just on that, it's worth, I think, highlighting that small businesses around the world since COVID have had it really, really tough. They seem to be differentially badly hit with the high inflation, and differentially hit with a lot of other stuff too, not least more red tape. Look at Australia, the number of small businesses that are falling over. So if in fact the net impact is more significant for smaller businesses, again, it's going to tilt the playing field to a smaller number of bigger players. I take you back to my earlier conversation about the shape of the exchanges and the fact that there's a few big companies that seem to be owning more and more of it. That's not necessarily very good. Neither does it actually necessarily lead to great innovation.
Yeah, it might not be good for, but it might be, if you're talking about the stock market, it might be all right for the stock market.
Yes.
Because these are companies, the biggest companies are making, and they make up the biggest proportion. And so maybe it doesn't look as if, bad at a lower level, but yeah, if they're all taking the pain, maybe the stock market actually ends up in not as bad of a place.
No.
Next one I had was this idea around inflation and US consumption. Okay, so this is probably going to have effect on a jump in prices, a general price of whatever, 5% maybe more. And chances are that US consumption is going to go somewhere else. That's going to reduce the US consumption. So you're spending you're buying the same amount of goods, but it's costing you more money. So you reduce your spending on going out or doing things like that. So there's that going on within the US. So maybe we've got some weaker US consumption numbers. There's also some tourism numbers out in the US that sort of go to show that, well, suggesting anyway, that tourism's down and maybe it's going to be sustainably down. Most of the tourism in the US is from Canada, and that's certainly fallen considerably. But the rest of the world as well, so seeing whether it be the army being called out in LA, or just problems getting through, stories about people made of being asked to show their Facebook and pages as they're going through US customs and things like that is enough to reduce US tourism, and so maybe that's another hit to the US economy on that. As part of the next one as well is then we're seeing a big crackdown on immigration and illegal immigrants. So do you end up with a bit of a worker shortage in the US? And that's one of those things we're talking about. Statistics is that potentially what's happening in the US at the moment is the employment stats are holding up not too bad, but maybe that's just because there's a bunch of undocumented immigrants who are now no longer getting the jobs or no longer getting the work that they were getting because they're being shipped off. And so there's employers out there that used to employ 20 people. 5 of them weren't on the books. They're sort of off the books. And now they're only employing 19 people. So it's worse, but they've actually added one more person onto the books because they're having problems finding the undocumented labor that they used to have. And so it's this idea that what's happening in the wages market and and is that and the other part is that the fewer undocumented workers you've got is probably good for wages. You're probably going to see higher wages within the US, and so worker shortage, bad stats for what's on there. Maybe higher wages actually helping some of the US consumers. You can see where it could get to the stage where it could knock off, could start harming the economy, but maybe there's enough pros and cons to that the US isn't as badly positioned.
Just quick observation there. The UK just released their unemployment data today, and it's up. It's a 4-year high, I think it is. But interestingly, that they acknowledge that the survey responses are now so low that they don't actually trust their own data, which is interesting because I think we have the same problem in Australia. I don't think that the statistics in Australia on employment are particularly viable either. So, again, it goes back to we're flying a bit blind with regard to some of these critical metrics. And then we've got the migration question and the undocumented workers question as well. And so
in the flying blind, it's a little bit even worse than that, isn't it? Our instruments telling us what's happening. Yes. We just don't know if we trust it. So
that's right. So you according to your instruments, that isn't a mountain just ahead of you.
Exactly. I'm high enough to go over it, and you're like, really? It doesn't look like I'm high enough to go over it. Yeah,
exactly.
So that was worker shortage. Number 7, we're up to higher interest rates and funding rates and higher housing costs. So interest rates are higher. We saw a little bit of a blowout in spreads. It seems to be coming back in again, but they're certainly issues, at least on that whole funding front. So, could you see that evolve into something bigger? Absolutely. As we spoke about before, I don't think it's quite there yet. I think not it's quite there yet. I think it's got a fair bit to go before I'm be concerned. But it's certainly one of the things that is on the radar in terms of could that cause problems.
Yeah, and just on that, I will just mention the Japanese 30-year, right? I think that's one to watch. You saw that it went very, very high, close to 3.2, and it's come back a little bit now because they've been trying to support the markets there. But this is another interesting, and in a way, the move in the Japanese bond market is more substantive than the US moves. But
yes,
it's in the same direction,
absolutely.
and it's saying that the cost of funds is going to be higher, and that, of course, crimps a lot of other things that we discussed earlier.
Yeah, and so I guess in Japan as well, it's also the proportionality, isn't it? In that you go, okay, look, whatever loan I had it at 2%, and now it's 3%, so that's gone up 50%, over the last year or something in terms of the. If I'm making interest payments, if I borrowed something a year ago at 2%, and now I'm borrowing at 3%, my interest payments have gone up 50%. Whereas, say in the US, if the rise has been more like 0.5%, but it was from 4% to 4.5% or 4.5% to 5% or whatever. So proportionally, the actual interest change isn't as much. I guess the US did its change, those big changes sort of 2 years ago in sort of as we saw that.
Yeah, and by the way, the Nikkei, of course, if you look at the trend on the Nikkei over the last year or so, it has gone up, but it's, the last few months it's been pretty flat. And
right. In yen, in yen terms. Do you want to bring up the Aussie? Have you got the Aussie dollar to yen as well, or the US?
I've got the US dollar yen.
Yeah, because that's where, when you overlay that same chart in US dollars, then it looks very different in terms of, because you've gone, from 160 back to 140.
Yes.
It's, and that's the not the eternal problem of Japanese equities, but it is an issue whenever you're buying Japanese equities. We sort of spend a long time looking at this, trying to work out the ups and downs on it. Is it you're often getting exporters, and particularly some of the bigger ones, Toyotas and stuff like that. And so it's this thing about saying, well, if I buy it and Toyota goes up 20%, but the Japanese currency moves the other direction, and next thing whatever gains I've made on these stocks, I've just wiped out in currency, and then vice versa. And often it works the same way, because when the Japanese currency falls, all these exporters rise because now they're going to be selling more Toyotas and making a bigger profit on it, and vice versa. And so there's a bit of any investment in Japan. The first thing we're always looking at is, right, what's it going to do when the currency goes in the other direction, and are we expecting that?
And here's the Aussie JPY. You can see there that it's been significantly lower at 60 in 2020.
15% from the peak, and
10%
from that's right. But you're probably 10% roughly from this year to last year, 93 versus maybe not quite 10%, maybe 7 or 8%. Yeah.
So it just shows you. And again, I think it's important for people to understand the relationship between what happens with exchange rates with some of these things, because as you say, when you look at the performance of markets, if you don't take exchange rates into account, then you're missing a very big factor.
Yeah, that's right. And you can pat yourself on the back for a job well done, and then you look at the balance in your account and you're like, just a minute, that hasn't gone anywhere.
Exactly.
What a great idea, buying this stock that's up 20%. And you just turn around and go, well, yeah, but in Aussie dollar terms, it's flat or whatever. So, okay. Shortage, higher interest rates. And the other thing as well, that does flow into the US, is that the idea of the housing costs in the US. So that's really locked the US in terms of sort of this interesting dynamic, because they have 30-year mortgages there, and most people, or a large part of the market, reset their mortgages at much lower levels. And so you might have a 3% mortgage, and if you'll refinance it, you'll end up with a 5 or 6% mortgage, and you want to move, but you don't want to change you're like, well, do I want to double my interest? I've locked in this fantastic interest rate. So what do I do? And so a large part of the US market is going, well, it just won't move. And they're high enough that buildings hasn't been particularly strong in the US, and so so there's some issues in terms of do house prices need to be higher in terms to spur the building on, given the interest rate levels, and there's just other stuff going on within that could cause problems within there.
Absolutely. The fact is, of course, the US housing market is not looking particularly strong at the moment. Demand is quite strong, but the ability to transact isn't very high. And this issue of those higher rates is really causing some eye-watering pain. People were hoping rates would come down, but they don't seem to be, because they're linked to the 30-year. So,
yes, and that's being affected by a lot of this. The stuff that's going on in terms of the bill, the big beautiful bill that they're trying to pass.
Yes,
and that's a great example of that. Who am I following? And I'm following Elon Musk because he's going to, and Bessent as well, in terms of saying they're going to reduce the budget deficit and bring back save all these costs, reduce the budget deficit, sort of give that back in tax cuts. And if that was your view, these are the two guys I think are influencing Trump the most. And now it's basically, as I said, Trump's sort of picking and choosing. He's going, well, I'll take the tariff stuff, and I'll take a bit of this other, some of this other stuff that I liked from that, but actually, reducing costs doesn't seem like much fun. Maybe we just pretend, let's create a bunch of things on that, and let's let's create a bunch of news about whatever for the cruelty about or whatever it is. Okay, we're not supplying condoms in Botswana anymore, and that's their problem, and I'll make a big noise about it, but actually the actual cost saving is almost nothing.
Mm-hmm.
And it's and then versus that flip side of saying, well, if I just keep up the spending, then that's going to cause completely different economic outcome than if I had gone down the route of actually, no, I'm genuinely going to make big cuts to all these different programs and bring the budget back into a more balanced state.
Well, I think a lot of the cuts were ideologically driven rather than economically driven, right?
Yeah, that's right. And I think there was a number of them that were designed for the headlines. They want, in the same way that there's some small protest going on. Well, let's send in the National Guard because that'll make the protest bigger and cause more, create more headlines for it. And you'll have all these people squealing about you can't do that and things like that. That's part of the theatre, I think. And so I think there was certainly that idea that building up soft power by providing all these different things to countries is a great long-term plan, but in the short term, there was political need to get rid of it. And I won't be in power probably, but by the time that those come about. Next one I had then was supply chains. Now, I'm probably less concerned about these than others. I do think there was, when we're talking about 130% tariffs on China, there's issues around that supply chains that can blow up some supply chains. But I do think the levels will come back to at 30% or 40%, whatever they are, they're back at levels that can be dealt with. And the other thing is, I do think supply chains were a little bit the last war, in that companies, supply chains hadn't been an issue for ages, and then suddenly, 3 or 4 years ago, they were the most important thing ever. And causing inflation and goods right around the world not being able to be delivered. Companies went and threw a bunch of money at the problem. And for every CEO that was just like, I don't know how stuff gets here. That's somebody else's problem how it gets there. I just set the bigger policy. And now they're like, actually, no, I need to know, and I need to have better systems and all that type of stuff like that. So I do think the supply chains has the potential to knock things off, and so I don't want to say it's a zero chance, but I just think it's a much lower chance of causing of being the sort of center of inflation or something like that this time around. So potential, but my view is probably not that important. The other thing, the next one, number 9, is this idea of you've purged yourself of all the compliance. You got rid of all the oversight. You've made it so that you can, anyone who might have been putting handbrakes on what Trump wants to do, or might have been, trying to make sure that there wasn't sort of favors being done for friends and all these other things going on has sort of been purged from the system. There's lots of assaults on the legal system about what's possible and what's not possible by a president. There was discussion about whether the Fed was the next one along the line, and to be frank, the decision that was made recently around that was basically saying, the Supreme Court basically said, okay, here's all these other institutions that look a lot like the Fed, that look basically the same as the Fed. Actually, you know what? You weren't, although, one reading of it says you weren't allowed to dismiss those people without cause. We're actually saying that, you do actually have power to dismiss all these people. Now, they sort of excluded the Fed by basically saying, well, the Fed's a bit different though. But they never really said why. And reading it is like, well, is it different? Like, it's not, like the reasons they've said, tend to be, I can't remember the exact wording, but it looked like it was certainly open to a challenge. It looked like certainly you could, without needing to be disingenuous, you could say, you could fire the head of the Fed and then, install your puppet and then say, well, I was just following, this rule you did on these other boards that where we weren't allowed to fire people, but now we are. And so I do think that's a long-term issue for the US. I think he's probably, he floated the idea of firing the Fed chair, and that caused a bit of problems with markets, and he decided not to. It's another one of these tipping points. I don't think it's going to be an issue in the short term. I think longer term, there's definitely issues for the US economy from it, and taking off a little bit of growth in the future, because this, you're investing in the US because you think the legal system will hold up, and property rights and all these other things. But could he decide one day that he really wants rates to be down, and Powell hasn't put rates down as much as what Trump thinks they should have gone down, and so he fires him and decides to work it out later. Do I think that could happen? Absolutely. And what would be the market response to that? And there's one more tipping point that's there. Sort of semi-related is this idea. Number 10 is this idea of is the US, is it descending into away from into some sort of kleptocracy, or what matters now is how close you are to Trump. So I think Elon Musk will be a bit of a test for that. We'll see. He was Trump's threatened to take away a bunch of his contracts, and it does seem as if there's companies like Palantir has really risen quite dramatically, and it's got some it's very much reliant on the US government, and some of its major backers are very close to Trump, and so it seems to be winning these things. Is that what needs to be? Is that the new market? Is it that it's sort of similar to China or to Russia in that you need to be close to the leader, and you need to have made the right political donations and all that type of stuff like that. And what does that mean? Is there a tipping point at some point where people start they stop trying? Well, I could set up this, I could set up this company and do all these things, but if Trump decides he doesn't like me because of something I wrote 5 years ago on Facebook that is out on the web forever, then he's just going to smash me like he did some other entrepreneur, and so I just won't even bother. And so does that? I think there is a tipping point at somewhere. Where that is, I don't know, but certainly moving somewhere along those point. That was 10. Number 11, I'm almost there. There's only a dozen of them. This idea of the Tistako trade and what's called reflexivity, which is fascinating in that, for anyone who hasn't has missed this, basically somebody's coined the term TACO, which stands for Trump always chickens out, with a view that the trade is whatever he says he's going to do, he's just going to chicken out of it. So when markets react in one direction, just take the opposite view. And there's, I think there's sort of, I think the attraction from it was, it actually sounds like one of Trump's own insults. And there's a whole little bit of Mexico in there, and there's a little bit of the, and Trump hates it. I can't remember what he called it when he was questioned about it. He hadn't heard it, but, they got him live on camera, hates the term, thinks it's terrible. And so does that actually create its own problems, in that the idea that Trump always chickens out is now a thing, and he doesn't want it to be a thing. And so therefore the market starts trading on the basis of whatever he says he probably isn't going to do anyway. And then eventually he actually does that thing because he's like, well, I'm not going to chicken out this time. I'm actually going to do it. And so you end up with that. It's the Minsky type moment where it's basically, people believe things are stable, then they start acting in ways that suddenly make it unstable. And so the taco trade's a bit similar in that it's probably works most of the time until it doesn't. And when it doesn't work, it's probably going to be a big one. And so there's this whole reflexivity. And so, so that's a lot of things, obviously, that I've been through. But the 12th is possibly even the most important one of these, is that we've spoken about all these confusing things going on and a myriad of all these events. And maybe the fact is that there's so much confusion that actually the confusion doesn't even matter as much, and that people just keep doing stuff. And so what I mean by that is, if you're faced by any one or two or three of these things where you're like, oh, tariffs are going to go off on my sole supplier, and this is the most important thing, and I'm not going to do that. I'm not going to build my factory, and there's capex, and I'm not going to hire people, whatever it is. I've got one problem to deal with, and I'm going to make sure that doesn't blow me up. But if you've got 20 different problems, it's your inventory cycle, it's your capex, it's your large companies, small companies, it's global companies, it's inflation, it's worker shortages, it's higher wages, it's higher interest rates and tax costs and supply chains and purging of US institutions and kleptocracies and trade reflexivities. It's all too hard. I've got no idea what's going on. Well, I'll just keep acting like things will be all right, and hopefully they will. I'll just keep spending money. I'll act as if the same event will be the right event. And because whatever I choose is going to be, I don't know what the events are going to be. And so maybe that's where the whole economic, disruption has come about, that maybe he is playing 4D chess. He's causing so much disruption that it actually doesn't cause disruption because nobody knows what to do. And so they just keep on doing stuff. And so, that's all those tipping points that could potentially come about. I didn't get into the positives, actually, which is worth sort of, the big picture for the US economy is he came in, he took power with a very strong US economy. Like it's been, so many things people thought was going to go wrong with the US economy didn't prior to Trump getting in. So we've got this US economy that's sort of plowed through all these other problems behind it. It's got the fiscal taps turned on. Joe Biden turned the taps on. So lots of money flowing in and lots of debts and deficits. We've got the big, beautiful bills going to turn them on even harder. And so we're going to have more fiscal to it. The US has got this productivity goes, whereas Australia's got this productivity, decline that we've got going on. And everyone's trying to work out how to explain. In the US, they're trying to explain why is productivity so good and how do we do that? They've got good wage growth and probably going to keep having decent wage growth with the crackdown on illegal immigrants. That's sort of all the current sort of position. And then in the future, you've got AI driving sort of more of the same. Driverless cars are really starting to take off in, subject to them being burnt in LA, but, they're doing hundreds of thousands of trips now. And probably about, I think the latest was about a quarter of the San Francisco market, taxi market is now driverless cars. And so, that's something which is creeping up on us and could be a pretty big, that whole sector's the biggest employer of people. And so there's potentially a reasonable productivity boom still coming through from that. We've got the weight loss drugs still tipping away in the background. We've actually seen obesity rates in the US stop rising. And so while that might not be, the greatest news, they're not really falling yet, but that's just been this constant sort of handbrake on the whole US economy every year. There's just more and more fat people who are having more and more health issues. And if that's sort of fading out, there's some productivity in that. Robotics, there's just the whole sort of next 5-10 years actually doesn't look that bad. The question is, are those tipping points I spoke about, those 12 tipping points, are they going to be enough to knock it all off base? And so, and any one of them can. Any one of them taken too far could cause enough to spiral the US into a recession, but maybe the combination of all of them doesn't. And so, that's where we're sitting.
And what you've done very eloquently is just to show all of those shifting sounds. And the question is, do they ultimately all, net out? It's a bit like having so many chords and so many sounds together that you just get noise, and is it white noise and you ignore it, right? So what's your strategy then in terms of the portfolio because you've got this portfolio, right, which you're managing, and you're trying to juggle all of these things? Are you saying, I'm just going to let it drift and see where it goes, or are you actually still, do you have the view that there are some stocks that you've got price chart targets, and if they get to those targets, I'm going to grab them? I mean, how are you dealing with that?
Yeah, so this is the investment under uncertainty part, which is and there's as much uncertainty as certainly I've seen. I think from a macro point of view, it's as much uncertainty, because I think there was, we've obviously been through some big downturns in the last, 30, 40 years, but a lot of those have been, we're having a financial crisis in 2008, and there's stimulus coming, and they're cutting rates, and there's sort of, you've got sort of the broad overview. You've got, okay, what are the types of companies that come out well out of those environments? What are the types of companies that suffer the most on the way down, and what are the types that come out? And so the timing of when you're at the bottom and when you're going up and all that is an issue, but the overall playbook is not as much. During the pandemic, we were similar, that, right, okay, we did very well in the early stages of that, buying up, the cleaning companies and, consumer staples and all those types of things, with a view that they're the ones, and then you're moving into some of the growth stocks as you go on. So the macroeconomic uncertainty around what should I be buying for the next phase that you're going through was more difficult. Was cleaner. It's just trying to pick where the trends were. Right now, it's a question of saying, well, will one of these things knock it off and you head into a recession, or one or multiple things, maybe it's a combination of all of them, and then you need a certain type of company. Or actually, we're heading to some sort of boom where we're throwing all this extra money at it, and you get this growth, ticking along. So for us, it's the types of companies we tend to sort of fall back to in this scenario is what I call quality companies. So quality companies, so a broad sense, the way MSCI, which is one of the big index providers, sort of breaks companies, is you're either a value stock, a quality stock, or a growth stock. And what does that mean? Well, you're either cheap, and so you're a value stock. Now, those companies tend to be cheap for a reason. They tend to have low margins. They tend to not have much price control. A lot of them are sort of commodity providers and things like that. And so the time to buy them is sort of getting close towards the end of the cycle, where they can actually start putting prices up, because a lot of them don't have any pricing power for most of the cycle. And then at some points in the cycle, they get pricing power, and so they sort of go up. And slightly when you're having, sometimes they're good in downturns. They've been good in some downturns, but not all. And so that's sort of it is a bit of a question for me on those value stocks. Growth stocks are the ones which are expensive, and people can't work out why. So the earnings are low and they're just expensive, and so therefore they must be pricing in some sort of growth. And those stocks are the ones which they do really well when you're going into sort of the boom times, and you're going into these phases where people worry about they'll supercharge you on the way up, but they'll supercharge you on the way down as well if you go into recessions. And so most upside, but most downside. And the quality stocks are the ones that tend to, when the markets are rising, do a little bit worse than the markets, same or a little bit worse than the markets. And then when markets are falling, they tend to do better than markets. And so they sort of, and so they're the stocks I'm sort of very much looking for if I can get them at the right price. And so they're the stocks that do have larger margins and do have better returns on capital. And so I can look at these ones and say, well, if a tariff hits them, if a tariff hits a stock that's got a 3% margin, these tiny little margins, all of a sudden they could send them into a loss. If a tariff hits a company that's got a 60% margin, well, there's much less likely of sending them into a loss. And it's a profit hit, but it's more likely to be a much smaller percentage profit hit. And so, so they're the ones we're sort of very much looking at. And we've got our sort of, it's a matter of saying, well, let's use this volatility to pick up some of these companies as they're falling. And there's different stories always about, is it Europeans about to get hit? Is it Japan's about to do a deal? China's on it, a deal's on and it's off. There's a lot of noise going around. And I think having those baselines and that saying, how can you just improve the quality of the portfolio in this time frame? That's the sort of key part for me.
Very interesting, Damien. Well, we're coming to the end of the show. Just to say, I did actually put a question in the poll, and the question was: by the end of June 2025, do you think your super balance will be higher than a year ago? And interestingly, 59% say yes, 26% say no, 10% say not sure, and 5% don't check the super balance at all, which is quite interesting. So, and it's interesting because there were some articles today claiming that the superannuation funds were going to be able to do another booming year because while they went down, they're now back up again. So I thought that was quite interesting. And, if you look at the markets are up quite high. So, this year net overall still has the chance of being quite positive.
Yeah, 10%-ish. So for markets. So, yeah, I think based on where they are now, my guess would be you're talking most super funds are in the sort of high single digit returns, which is, so I'll take that every day of the week. I think there's, I talk about your overall returns for markets as being somewhere between 6 and 9 for stocks, but really broad outcomes where it's plus or minus 30% on the end of those. So you start saying, okay, well, I'm doing whatever, 7.5%, but it could be 40%, it could be minus 25. Sort of your 95% confidence interval. And then, but by putting in multi-asset funds, which is what most super funds do, is you can dramatically bring that back without sacrificing too much on the returns. So your returns fall back, maybe 0.5%, but you bring it back to maybe it's minus 10 to plus 25. And so you've got a much, much lower range of outcomes, but at without too much of a penalty on your returns. And then there's also there's that problem. The constant problem you have if you're sitting with lots of cash sitting on the sidelines, or you're about to make a big investment, is that, well, if today's the day I put it in and today's the day just before the market's about to fall 20%, that's obviously much more painful than trying to pick that bottom. But for something like a superannuation where, particularly for anyone who's still got 10, 20 years to run, you're putting more money in every single year, and it's more money is just going in over time. And it's a question about saying, well, on those ones, you probably should be a little bit less concerned about reducing the volatility and happier to take some of the volatility for that higher return. The closer you are to retirement, now you want to start trying to dampen those returns down so that you're not sort of ending up retiring just as into a big market downturn.
Yeah, and the last question before we just close out, of course, the debate currently on the unrealized superannuation tax strategy above 3 million. Two observations. The first is that only a small number are caught initially, but if it's not inflation adjusted, more people will get caught in down the track, potentially. And the second issue, of course, is that the opening the stable door and letting the horse out, once you've actually realized that the Treasury can use unrealized gains as a mechanism to assess tax, or they could apply it to others later. So there's an important policy thing. But interestingly, I did note today that in the latest discussions, they're saying people can actually use money in super to pay the unrealized tax gain if they need to. So that's an interesting little tweak. But to my, this is another chaotic element, amongst many chaotic elements as to what to think about.
Yeah, so I've got three things I want to talk about around this. One is the idea of the balance and who's affecting. Look, I get the argument. Look, if they don't change it, they'll get so many more people, and look, maybe it will over time. But you can make exactly the same argument with our tax system. With 47% tax on the highest tax bracket, if they never change that, then that's going to contain X percent of people as well. At the moment, it's only a small proportion, but you can get everyone in there if paying 50% tax if you never change it. So I think that's one part. Our rough numbers go, if you've got about $2 million, 2 to 2.5, sitting in mostly equities, but maybe a bit of bonds just to bring back your volatility a little bit, you can live a comfortable retirement on that and not dip into have your balance keep going up. So at $3 million, if you're generating a 7% return on that, you're doing all right. You're probably talking about $200,000 or whatever it is, and of that, 150 of that's going to be tax free or more. Maybe, so if you're talking, especially if you're talking about maybe if you've got two people, if that's across two people, maybe the whole lot's tax free. If you had, but sorry, no, you can't have two people with the $3 million. Yeah, but I guess what I'm saying is, if that's only for one person, that's a lot of money. And to be saying that, okay, I only want to pay 15% tax. So the idea is that on the $2 million from as of 30 June, if you've got $2 million in pension phase retirement, you're not paying any tax at all. If you've got that extra $1 million, that's paying, once you get over, the extra $1 million, then you're paying 15%. And once you get over that extra $1 million again, anything above that, now you're paying 30%. And you're like, well, I'll tell you what, how about I do a deal? Rather than that tax rate, how about we take that and stick it back in your own name, and so you can't have it in super anymore, and see how many people take up that deal? Because they can. Most of the time, if they've got those balances, just take it back, stick it in your own name. Oh, no way. I want it in super because it's got a much lower tax rate than what I'd be paying in my own name. If I had an extra $1 million in my own name earning all that money, I'm out paying 47%. Same as, somebody else who might actually be earning money. And so, I do think there's an element of saying, how much money is in that, how much money is in that super? Should you be paying tax on it? Look, I think there's probably a fair argument to saying you should be paying tax. How should there be tax? Look, I prefer it's not on unadjusted numbers, because there are people, and I've spoken to people who have, say industrial property they've put in there because they might have put it in there as that they're as part of their self-managed super that they're actually owning themselves, and so it's like, well, unrealized gains, and all of a sudden they don't have any money in their super because it's all in that, and they've been paying down the debt, and they've got to do whatever it is. There's issues around that. Sure, there's problems, but the flip side is it's a lot of money. You should be fine for retirement. Take it, stick it in your own name. See if it makes it any better. It almost certainly doesn't. And so, I think there's and there's the point about it's not much money today, and in future it will be, absolutely. But that's the argument. That's the same argument for everything with those. You're saying, that's not, if you said, I think I saw a comment to saying, look, in 2050 it will be a big issue. Yeah, it will be a big issue, but that's the problem for voters in 2050. It's not the problem for voters in 2020. Yes, it should change over time. I completely agree, but so should the thresholds on income tax, and they do, because people complain about them. So,
and it's worth saying there are some other countries where this has been in for some little time, realized gains thing, and the world hasn't completely blown up, but it is interesting how this has become a really hot issue in the Australian context. So fascinating, isn't it?
Yeah, well, there's all these articles about showing, what would happen if you had $2 million? Sorry, not $2 million. What would happen if you had $5 million and you did this and you did that and whatever? And it's like, man, is that what we're like? That if we're worried about the retirement money for people who have $5 million, you're fine. You're fine. As I said, if you've got $2 to $2.5 million, there's AFSA does this survey about what do you need to have a basic retirement and a comfortable retirement. And if you're spending the comfortable retirement and you've got $2 million, you should be going ahead you shouldn't be eating into your capital. Your capital should be probably going up over time if you're just spending that amount. Maybe you probably should be spending more, but it's that idea that really we should be more worried about the levels of tax credits we're giving to people, and is that the best way? And it's this whole idea of maybe we should just say once you hit to $2 million worth of tax-free amount, maybe the rest of it should just go back into your own name, and let's let the normal tax system sort it out. Why do we need to let some people have $150 million in superannuation?
Yeah, and I'm fascinated that the debate we should be having is about corporate taxation and how few companies actually pay tax versus what I think they should be paying, particularly gas companies, for example. Just a little side swipe there on the way out. Damien, that was a very, very interesting conversation. Thank you so much for taking us through that. I think it was really insightful. And, the conclusion I have is, no, this isn't normal, but it's complex. And there are so many moving parts to it. So trying to make a prediction now as to where things are going to go is impossible, which means that the strategies are more about understanding that uncertainty and then factoring it in when you make decisions or perhaps postpone decisions.
And keeping in mind those risks, I suppose there's probably some more risks out there as well, but there's a number of things you need to be watching, and those are the ones where it's like, this could blow it up. The inventory cycle done wrong could blow it up. Doesn't look like it's going to, but it could. Inflation could blow the whole thing up. There's just got to keep going through each of those and trying to work out the which of these things we need to be watching and paying attention to over the next coming 2 or 3 years.
Wonderful. Damien, thank you so much. We will have you back on, I think, in 3 weeks' time because of the slight move this time around. So I look forward to that, and maybe we can talk a little bit more about some of those things. One of the things I'd like to discuss next time is the idea that the investment in arms and war is actually good for the economy, because that's the argument now being trotted out in a number of countries, which I think is quite interesting. And the concept of a war dividend without a war is something that's worth thinking about, because to my mind, that's turning a lot of things on its head. So I think that might be something we might want to cover next time.
Yeah, absolutely. And a quick plug for our fund, the Walk World Fund. You can switch it on and off. So you don't want defense stocks in there, you can get rid of them. You do want them in there, you can kick them out. And we do have sort of 2 categories as well in terms of kicking them out, which is the worst offenders and the any. And with the idea that the worst offenders are the guys making landmines and nuclear weapons, you sort of kick those out. Or you can just say, no, I don't want anything to do with a military, which means companies like Boeing, for example, might not end up in the portfolio.
Absolutely. Damien, thank you very much.
Or you can add them in. Yeah.
Good point. Thank you so much. Loved that. Very nice conversation tonight, and so insightful. I'm going to take you offline. I'm going to close the show, and I'll look forward to catching up with you next time. So there you go. Luckily, the switch didn't crash, which was good. Next week, I'm going to be talking about my latest surveys and the stress analysis, and all those are good things. And just a quick reminder for those who might be interested, there is still a chance to have Harry Dent and Troy Harris and I going to talk tomorrow. It's actually going to be 7 a.m. and 7 p.m. There's a link in the comments below if you want to sign up for it. I'm still negotiating to see whether I can also get it to come on YouTube. It's not there yet, but we might also be able to put it up on YouTube as well. So keep an eye out for that. Thank you very much for spending some time with us this evening. Keep safe. Have a good evening, and I'll look forward to seeing you next time. The doggies are still here. Yep, that's good. So they've been quite quiet this time, which is excellent. And I look forward to seeing you next time. And of course, daily shows in the meantime. This is Martin North from Digital Finance Analytics signing off. Take care. See you next time. Bye.